Okay, imagine this for a second. You work a whole month, right? You're brokering huge loans, like maybe 900 million Korean won. Big number.
Yeah, that's serious volume.
Exactly. And you're thinking, okay, decent payday coming. But then after all the fees and everything, you actually take home 1.8 million won.
Wow. That's
Yeah.
barely anything for that kind of work.
Right. Barely minimum wage, maybe not even. Or think about this. A government policy, maybe a totally necessary one for the economy, suddenly just pulls the rug out from under thousands of people, just overnight.
Mm-hmm. The unintended consequences.
Precisely. Welcome to the Deep Dive, everyone. Today we are looking closely at an article from the Seoul Economic Daily. The title translates roughly to Brokerage of 900 million won for 1.8 million won. People collapsing due to loan regulations.
It certainly grabs your attention.
It does. So our mission today is to really unpack the human side of these big financial regulations, specifically this 6.27 regulation push in South Korea. We're focusing on two groups that maybe don't get the spotlight often in these discussions: loan brokers and debt collectors. We'll look at the numbers, sure, but also the personal impact of what it all means.
Yeah, it's always striking how these, macro level decisions, even the well-intentioned ones, can just cascade down and hit individuals really hard in ways you might not expect.
Absolutely. So let's start with the loan brokers. The article talks about someone called A, an agent for a commercial bank. Tell us about their situation. What's the reality for them now?
Well, Agent A's story is pretty stark. They told the paper they're basically just staring at their phone all day, hoping for an inquiry that rarely comes.
Wow.
In one whole month, they managed just two home equity loans, one for 400 million, one for 500 million, so 900 million total.
Okay, that's the figure we heard at the start.
Right. And the kicker, their actual take-home pay after the brokerage firm took its cut was just that 1.8 million won.
1.8 million from 900 million in loans. How does that even work? The math seems far off.
It seems off, doesn't it? But the way it works, the agent might get a commission on paper of, say, 0.3 to 0.5%, but then their company takes a big chunk.
Oh.
So what they actually receive, their net, is often only around 0.2%. Do the math on 900 million, and you land right at 1.8 million won.
So it basically makes the job almost impossible from an earning perspective.
Pretty much overnight, yeah. It just completely changes the economics for them.
And just to give you, the listener, some context, the article points out that just to make South Korea's minimum monthly wage, an agent now needs to broker over 1 billion won in loans every month.
1 billion won, that's a huge hurdle.
Yeah. A single 500 million won loan sounds massive, only gets the agent about 1 million won in their pocket. And Agent A, they mentioned going from maybe 10 inquiries a day earlier this year to struggling to get even one a week.
That's a drastic fall off.
Yeah.
And it ties directly back to the 6.27 regulation from the financial authorities. Banks are just tightening the screws on these external agent channels because they have these new overall lending limits, these aggregate regulations.
And this is happening while the property market is slowing down too, right?
Exactly. You've got the real estate market cooling rapidly, household debt dropping overall. Even things like credit loans, personal loans, they're now capped at your annual income. Used to be maybe double your salary.
Wow. Okay, so it's a perfect storm, kind of.
It really is for these agents.
And the banks themselves, what are they actually doing? Are they just telling the agents no more?
Well, they're taking pretty concrete steps. The article mentions Shinhan Bank, for instance. They've apparently suspended taking any new applications through agents for home loans in the Seoul area for August and September. Just stopped. Hana Bank stopped taking applications for loans that would be paid out next month, and they even halted July's applications back on July 7th.
So really shutting the door quickly.
Yeah. And NH Nongip, they've put monthly caps on loans coming through agents for both home equity and Junzi loans, just trying to control the volume.
So it's across the board then.
It seems like it. It's a very clear signal.
And we're not talking about a handful of people here. How big is this loan agent industry?
It's significant. The article cites numbers from back in February. Hana Bank had around 740 loan counselors, Shinhan over 720, NH Nonghype 610, Wori 550, KB Cookman nearly 500.
Wow, so thousands just across the major banks.
Thousands, yeah. And they were doing huge business. Last year alone, these agents handled over 77 trillion won in real estate loans.
77 trillion.
Yeah, so they were a really key part of the system. A financial industry official in the article sort of sums it up, saying, look, these regulations might be necessary for the economy overall.
Right.
But these agents are collateral damage. They're suffering this unintended, indirect damage, and there's really nothing they can do but wait and hope things loosen up again.
Unintended, indirect damage.
That phrase really sticks, doesn't it? It feels so random, like being hit by something you didn't even see coming.
Exactly.
And it's not only the loan brokers. The article makes it clear that the second-tier financial places, savings banks, capital firms, mutual finance companies, they're feeling a similar pinch.
Mm-hmm. They're facing similar issues with lending restrictions, especially things like subordinate home equity loans, second mortgages, basically.
Right.
And other credit products, too. Their channels are drying up as well, but there's another layer for them.
Oh, what's that?
It's this large-scale government debt adjustment program that's causing a whole different kind of headache, particularly for their debt collection staff.
Okay, so shifting gears from new loans to old debt. What's this debt adjustment program about? How does it impact the collectors?
So there are two main parts, as the article lays it out. First, debt forgiveness for small business owners who took out loans during COVID. Up to 90% forgiveness, capped at 100 million won.
Okay. Significant relief for them, definitely. And the second part is writing off old, small debts. We're talking loans under 50 million, one that have been delinquent for 7 years or more. Long-term overdue debt.
So these debts, which are often held by those second-tier institutions,
Precisely. Savings banks, capital companies.
they're either being moved to a government agency, KMMSK, or just wiped off the books entirely.
That's the plan, yeah. Transferred to the Korea Asset Management Corporation or written off.
Which means there's nothing left for the debt collectors to actually collect on those specific loans.
Exactly. Their pool of work just shrinks dramatically. And the scale here is huge. The policy affects something like 1.23 million people
Wow.
and involves principal loan amounts totaling 22.6 trillion won.
22 trillion. That's enormous.
It really is. And there's a quote from a savings bank official that puts it in human terms. They said, roughly 50 billion won of non-performing loans creates work for about 15 debt collection personnel.
Okay, so you can see the direct link. Debt equals jobs in that sector.
Right. So while everyone acknowledges this is, vital relief for people burdened by old debt for years,
Sure.
the official calls it the other side of the coin. People working in collections are losing their jobs because the debt they were working on is suddenly gone, either sold or written off.
That's the human cost, starkly put.
Mm-hmm.
The article even mentions one large savings bank, just called B,
Mm-hmm.
that has over 200 staff working in debt collection across its main office and affiliates, all potentially impacted.
200 people in just one company. It shows you the potential scale of the job losses here. It's not insignificant.
Definitely not. That
Yeah.
phrase you mentioned earlier keeps coming back to me.
The unintended indirect damage.
No, the other one from the second source.
Ah, the stray bullet.
Yeah. That's what another financial source called it, right? Describing both the loan agents and the debt collectors as being hit by a stray bullet from government policy.
Yeah. It really captures that sense of being caught in the crossfire of larger economic forces, doesn't it?
It really does. Okay, so let's try and wrap our heads around this. What we've seen today through this Seoul Economic Daily piece is how these big, necessary-seeming economic policies
Mm-hmm. For stability.
for stability,
Mhm.
can have these really sharp, unexpected impacts on specific groups of workers. We saw loan brokers, suddenly struggling to make even minimum wage.
Yeah, their whole business model upended.
And then debt collectors facing potential job losses on a large scale because the very debt they manage is being restructured or written off by government action.
It just underscores that complex balancing act, doesn't it? Systemic financial health versus individual livelihoods. There are always trade-offs.
There really are, and it brings up a tough question, I think.
Which is?
Well, when policymakers are designing these big solutions for big problems, what's their responsibility, ethically speaking, to foresee and maybe cushion the blow for those who get hit by these stray bullets? The people caught in the middle through no fault of their own.
That's a really profound question. How do you actually calculate and account for those unseen or at least unquantified human costs when you're making these necessary economic adjustments? It's not easy.
Not easy at all. It's definitely something for all of you listening to think about. Can you see similar ripple effects, maybe these stray bullets impacts, in other industries or maybe other policy changes you're familiar with? Something to chew on. We'll certainly keep exploring these kinds of questions in future deep dives.